If you've been paying attention at all this week, you've probably noticed that the market has gotten increasingly volatile. This week, we're going to break down why that is happening. I was going to use this week to talk about my 10 years at 10 Capital, as my personal anniversary is coming up on February 16th. But I've decided to save that for another time, as obviously there is more pressing matters as we're seeing volatility creep into the marketplace. You've probably heard me mention before, and if you have, I'm sorry for repeating it, but the same part of the brain that gets triggered when someone is in mortal danger gets triggered when you're losing money. My analogy is, it's basically the same from a psychological standpoint, getting chased by a bear, as it is getting chased by a bear market. Very rational people start to think and act irrationally. I know all of you who are clients out there think very clearly about your portfolio, but that doesn't mean that those thoughts and doubts don't start to creep in as the volatility picks up. So when we break down what we are seeing, first and foremost, we've seen a real increase in what's called the VIX, or the volatility index. I like to refer to it as the fear index. It's actually gone up 90% since January 14th, which is a large trigger to tell us that people, retail investors as a whole, are becoming very fearful around the markets. And this week, what we've seen is a lot of days where the market has started off up, and then there has been an announcement or something that has caused it to drop fairly significantly toward the end of the day. Some of those factors that have caused the market to whipsaw more than normal is the Fed. Of course, we've been hearing for a while that interest rates are going to begin increasing. And that makes complete sense based off of how low we've held them over the last decade. On Tuesday, the Fed came out a little more hawkishly than we had imagined, stating that we may see a 50 basis point increase in March. That caused the market to really fall off toward the end of Tuesday. Some of the other factors that have played into the increased volatility this week are fears about what's happening with Russia on the Ukrainian border, and are we looking at a potential invasion, which would certainly create a lot of turmoil, not only in the broader global economy, but especially in Europe, where a lot of gas and oil flows in from Russia, and that would really create an issue when it comes to NATO countries having to decide how they're going to go in and potentially help protect Ukraine. One area that's been interesting to watch this week is earnings. And as corporate earnings have come out, even though a lot of companies are reporting better than what we expected from an earnings standpoint, we're still seeing investors look at that from a negative standpoint, potentially still viewing a lot of these companies as being overvalued. The last factor that we've looked at this week that is creating some of that up and down that we're experiencing is COVID. And even though we've been dealing with COVID for a long time, some people are becoming very tired of how it's affecting day-to-day lives. It's still playing a role in the economy, looking at, will there be lockdowns? Is that going to continue to create issues with supply chains? All of these factors have created an environment this week that has been less than ideal. Now, before we focus too much on how this affects things long term, I think it's important to remember that what happens here in the day-to-day does not have a long-term impact on how we should view our portfolios acting and reacting. First and foremost, if you've done any kind of financial planning, you know that what happens in the short term does not play a large role in whether or not you're going to be able to A, take income if you need that from your portfolio, and B, worry about whether or not you're going to have long-term success as part of your financial plan. A slide that we like to reference with clients that shows the impacts of both geopolitical events and other areas that have been scary headlines in the past is one that we're going to throw up right now from American funds. This slide does a great job of walking through if someone invested money right before the 2008 financial crisis and held those dollars until the end of 2020. What we're referencing here is that the S&P 500, or the US stock market, actually performed at an average of 9.09%. What you'll see during that time is there was a lot of things that you probably remember hearing about on the news or worrying about as part of your own financial picture that people thought were really going to derail the economy and the economic outlook. As you can see, it's not that there isn't impacts based off of geopolitical events or other things that we fear, but it does mean that if we stay the course, if we don't panic and make an emotional decision to sell at the wrong time, long term, markets are efficient and we get to where we want to go. So to close, headlines were scary this week. We saw more movement in the market than maybe we would have liked. But we need to remember to not let emotions begin to impact the decisions that we're making on the portfolio. If you have questions, call. Some of you have. Some of you, it may be on your mind to do so. Any of us would be happy to walk you through not only what we're seeing in the market outlook, but how it may or may not be affecting your portfolio. Thanks for joining us this week, and have a great weekend.